Stay tuned for part 3. It is coming at you super soon. And now it's time for Series 7 Definitions Part 2. Don't forget to share, like, subscribe, all that good shit. There might be a Part 3 out of this, but now we're going to talk about the rest of retirement education plans, regulations, some trading market stuff, and then definitions, more definitions, like one-offs. And then I have a whole thing with synonyms. Like there's 3 different words for coupon, nominal, interest rate, stated rate, all that stuff. I'm going to try to do a lot of them because a lot of people have trouble with them. Let's get back to this. So annuities do not step up cost basis. So if I put in 20 grand and it grows to 100 and you guys inherit it, lucky you, you're going to pay taxes on the 80 grand. Now let's add one more thing into this. Let's say the annuity is growing up since I'm here and I take the money out. I start withdrawing the money. It's going to be on a LIFO basis. I think I'll cover LIFO later, but a LIFO basis, which means if I put in 20 and it goes to 100, the first 80,000 I take out is taxable at ordinary income. Remember, all retirement accounts are ordinary income. Then the last 20 I take out is a return of principal, which is when annuitizing, the contract owner chooses a payout option. Life only, which pays until I die. Only me. It's the highest periodic payment, but nothing happens after death. Life with period certain, payment for life. But if death occurs before a minimum period, payments continue to a beneficiary for the remainder of the period. Let me do that. So let's say I do a life annuity with a 10-year period certain. That period starts from when I annuitize. So for the first 10 years, even if I die during the 10 years, they will pay out for the balance of the 10 years. But if I live beyond the 10 years, then it will just end when I die because it's a life with period certain. It pays for my life, but no less than the first 10 years or 20, whatever I paid for. Now remember, the longer I guarantee payments, the lower my payment is. Life only is always the highest payout choice. When you hear the dog barking, they're probably coming. He can hear it from fucking 5 miles away. Joint and last survivor. Payments continue until both annuitants die. One of my friends calls it a last to die policy. So you and I, we're a cute little couple, whatever you are. We do a life with period certain, joint and last survivor. If I die first, you bastard, it's going to pay until you die. If you die first, then it's going to pay until I die. That's joint last survivor. The last one is a unit refund annuity. Now, what that does is it says, okay, if the person dies before they paid out, it'll at least give back the money I put in. And the choice you choose, so whatever you choose affects the size of the payments. Anything we add, remember, anything you add for the investor, meaning joint and last, period certain, unit refund, it's going to lower the payment. Take money out of an annuity, it comes out LIFO. If an annuity is funded with after-tax dollars, non-qualified annuity, which they mostly are, unless they say qualified, distributions are taxed under LIFO, last in, first out. Earnings come out first and is taxed at ordinary income because it's always ordinary income, while the original principal comes out last is not taxable. So return of principal is always considered non-taxable, return of capital. Thus, any withdrawal before the account is annuitized is fully taxable until all the earnings the growth has been withdrawn, then we hit the principal. If you take it out before 59 and a half, they add a 10% penalty on that, unless there's some good reason, which I don't think there are any. Once you annuitize, each payment is going to be partially taxable, partially not, because your payments for life are going to represent, right? They're going to represent what you put in versus a growth. So if you put in 20, it grows to 100. Well, 20% of what you have is what you put in. 80% is what it's grown. So 20% of your payment will be tax-free. 80% will be taxable. That's called an exclusion ratio. Again, you don't have to do the numbers, baby. Okay, I think I'm almost halfway. Next up is brokerage accounts. Let's see how far we can go. Cash account, a brokerage account in which the client must pay the full amount of securities purchased by the settlement date, which is T+1. No borrowing is used. All trades are settled cash on delivery. In a cash account, short sales and margin trades are not allowed. Securities can still be paid from the cash account via the available cash or depositing funds. Now, here's the thing. I say T+1, but in reality, it's T+3, okay? Because Reg T allows me 3 days to pay for something. Now, there's not a firm in the world that really lets you do that anymore. So if you want to do, I try to buy shares when it's down, put more money in, and then I wait a day or two. So when you buy in a cash account, that really just means you pay full for everything. You can do certain things like covered calls. You can buy buy stock. You can buy mutual funds. You can buy some options, like certain options you can do. Anything where you're not borrowing money or putting it down. So cash means you're paying cash on the barrel. Okay. And again, you do get T+3 to pay for it, but settlement is T+1. Okay. A margin account. It's a brokerage account that allows the investor to purchase securities by borrowing a portion of the purchase price from the broker-dealer. So if I'm going to buy $10,000 worth of stock, I'm going to deposit like $5,000 and borrow the rest, which is called the debit balance. The brokerage firm lends the money, charging interest. They really get it from the bank, which is a broker loan rate, but it's fine. The brokerage firm lends money, charging you interest, a lot of fucking interest. So you never, ever do margin to get income. You do not buy preferreds. You don't use margin to buy preferreds because the interest you're paying on the borrow is way higher than you're going to get from the preferreds. Regulation T of the Federal Reserve Board currently requires an initial deposit of 50%. So when you want to buy stocks, you have to deposit 50% initially. The remaining balance is loaned by the broker, called the debit balance. Margin accounts also permit short selling of securities since the investor borrows the shares to sell short. Now, Reg T, the Federal Reserve Board regulation that governs the amount of credit that brokers can extend to customers for the purchase of securities. Reg T currently requires that customers deposit 50% of the purchase price. Now, there are things called portfolio margin and strategic margin, whatever you want to fucking call it, where you can put down less based on the risk. We're not talking about it. They have to put down 50% initially. Now, that also means if you buy something full, you can then borrow 50% of it. It also sets the payment deadline. So Reg T is not only the borrow part, but that S+2 I just said, settlement plus 2 days. So regular way settlement is T+1. That's when you settle the trade. That's when it's all settled up and the money's back and forth from the broker-dealer. So if I buy shares on Monday, the broker-dealer will send money to the seller by Tuesday, and the seller will send the shares by Tuesday. I actually have until Thursday to pay for it, whatever. Now, if payment is late, the broker may request an extension or must sell out the position. That's called a Reg T violation, which if you get a Reg T violation, not paying it in time, and even with the extension, they freeze your account, which is not that big a deal. Just means for the next 90 days. So for the next 90 days, if you buy something, you have to pay up front. They're not going to trust you anymore. But then after that, it's over. Okay. I got in it when I was 16. I was trading options in my mom's account. I was buying Toys R Us every December, selling them in January. It shouldn't have worked, but it did. I made money every year. One year, I was a college kid. After a couple of years, you keep doing it every year. By the time I was 17, I was in college, and I didn't have money, so I didn't have to pay for it. It was on the phone. So I called the person and said, I don't have the money. He goes, I'll get an extension. He got an extension. I still didn't have the money. So he goes, well, okay, well, I don't have to freeze your account. And I started panicking. I was almost going to cry. I'm like, my mom's going to kill me. He goes, relax, fucking pussy. All that means is that you can't trade without paying for it up front. Can't believe he called me that. But then it was fine. After 90 days, my mom never knew because she pays for everything up front everywhere, so it doesn't matter. She had money in the account. She had up a separate one for me to trade options and whatever. He knew that I was underage, but nobody gave a shit. So the point was, I didn't have the money. They froze my account for 90 days. And then after the 90 days, I could trade again. I just had to pay for everything up front. Now, minimum maintenance. Now, that's Reg T, okay? Now, minimum maintenance is set by the exchanges like FINRA and the stock exchange. That's not 50%. Remember, so like when I buy stock, it always goes the wrong way. So the question is, if I put down 50% and then it starts dropping, at what point do I have to come up with money? This is called maintenance margin. The minimum maintenance. Oh, do I talk about it later? Let's see. Oh, I do. So I'm not going to talk about it now. I'm going to talk about it later. Moving on. A margin call is when the company, the broker-dealer, demands money. A demand by a broker that an investor deposit additional money or the money in general or securities into a margin account. A margin call is when you have a margin account and you have to put money in, whether it's initial or additional. If it's additional, sometimes they call it a maintenance call, but whatever, because you're below the number I'm going to get to in a bit. If the value of the securities declines too far, the account's equity percentage drops. Under FINRA rules, the minimum maintenance margin is generally 25% of the market value, and if you're short for long, and it's 30% for short. If equity percentage falls below that, the broker issues a maintenance or margin call for the amount needed to bring it back to the maintenance level. Remember, if you don't have to get back up to 50%, you just have to get back to the 25 or 30. If I don't come up with the money, they may liquidate. They will liquidate the securities and to get the money and then freeze my damn account. Now, specifically, minimum maintenance, the minimum level of equity that must be maintained in a margin account after the purchase is made, not initially, that. Now, there's two of these. For equity securities, FINRA's maintenance is 25% for long and 30% for short. Now, the firms can set higher house requirements. Now, there's another thing here. Also, you can't put less than $2,000. So if you have less than $2,000 in the account, you just can't use margin. So if you're going to buy stock and you can't use margin unless it's at least you're going to have $2,000 in the account. So it's 25% on the long, 30% on the short of the market value, but never less than $2,000. Again, if the account equity falls below the percentage or below $2,000, a call is triggered, and the broker will say you got to come up with some moolah. Excess equity SMA, kind of the same thing. So remember, I've never felt this, but if you buy stock on margin, you put down $5,000, you borrow $5,000, and it grows. Well, remember, they only want you to have 50% at all times. So as the market goes up, you're building equity. If your equity goes over 50%, that's called excess equity or SMA. So again, you put down $5,000, you borrow $5,000, the stock goes to $12,000. You now have $7,000 in equity, right? You can withdraw the amount over the. Now, always remember, it's your minimum maintenance is always your Reg T is always 50% of the current market value. So if the market goes to 12, okay, your Reg T is now 6%. But you still only borrowed 5, right? So your equity is 7, you can borrow 1,000. So again, excess equity in SMA is how much equity you have above the 50%. I'll say that again. SMA and excess equity is how much equity you have that's above 50% of the current market value. So again, I buy 10, I put down 5, I borrow 5. The market goes to 12. Well, my equity is based on my market value minus what I owe, the debit, what I borrowed. So that's $7,000 of equity. But now 50% of 12 is 6. So I have $7,000 in equity, 6,000 in Reg T, 50%. So I have 1,000 in SMA. Just remember, for every dollar that your stock goes up, your SMA goes up a half of that. Okay. Now, if a margin account's equity rises due to stock appreciation, half of the gain goes to SMA. SMA can be used to purchase more securities without depositing cash, or you can even withdraw it and pay a bill. It's like a credit line, okay? But if you use the SMA, you're increasing your debit balance and reduces your equity. Fair. If you want to do this, you have to use a margin account. I'm jumping around a little bit. A short sale. The sale of a security that the seller does not own, performed by borrowing the security, usually from the broker's inventory or another margin account from a client, and then selling it in the market. The short seller hopes to buy the shares back at a lower price, covering the short and pocket the difference. Short sales must be done in a margin account due to the borrowing of the securities. The short seller is responsible for paying any dividends on the borrowed stock to the lender, right? So if I short the stock and I got the dividend by mistake, I have to give it to the person who lent me the shares. Regulatory rules called Reg Show require brokers to locate shares to borrow before shorting, and impose a short sale price test. If the stock drops by a certain amount, if the stock drops by 10%, they limit how you can short. But let's get into this. So if I hate NVIDIA, which I love, if I hate NVIDIA, it's trading at 120, I think it's going to go to 100 because of DeepSeek, that crap. Hopefully one day you'll be watching and go, DeepSeek sucked, NVIDIA's great. So I'm going to borrow the 100 shares of NVIDIA from you. Now, remember, before I do this, I tell my broker-dealer they have to locate it or borrow it. If they find that you have it, it's located, or they just borrow it from you. Either way, they have to get a locate or borrow. That's a rule. You can't just willy-nilly short. I'm going to borrow the shares from you. You won't even know I probably did it. Then I'm going to sell them in the market at 120. So that's selling 100 shares at 120. That's $12,000 in my account. Yes, that's weird. I sold your shit. In any other world, that's a fucking felony, but we're going to go with it. Now the stock drops to 110. So you know what? That's good. I will then buy the stock back at 110, spending $11,000. I brought in 12. I spent 11. I give you your stock back and I make $1,000. Where's the fucking risk? That what if the stock goes to 13, 14, 15, or 20, 120, 30, 115, 120, 130, and you want it back? I have to go buy it back at that higher price and give you the stock back. That I could lose a lot of money. I have unlimited loss potential. Look up GameStop. I did a video. Now, Reg Show puts a lot of restrictions on it. Also, if the stock drops by a lot, there's called an uptick rule or up bid rule, or if the stock drops by 10% from last night's close, they limit how much you can short. Because remember, shorting is bearish, and if you short, if you sell something, you push the price down. So this limits how much you can put the price down. That's called this short sell circuit breaker. Now, when you open a margin account, you are going to fill out a hypothecation agreement. That is allowing your shares to be used as collateral. So let's go with the definition. Hypothecation is the pledging of securities as collateral for a margin loan. When a client buys on margin, they sign a hypothecation agreement, giving the broker-dealer the right to use the purchased securities as collateral. Remember I said they borrow from the bank? As collateral at the bank to obtain the loan funds. This repledging by the broker to the bank is called rehypothecation, which you allowed. Customer securities in a margin account are typically held in street name and can be rehypothecated up to about 140% of the debit. If the customer defaults on the margin loan, the broker then can sell the hypothecated securities to cover the debt. So hypothecation is pledging your shares as collateral to get the loan that must be signed. There's also a credit agreement. I don't have it here. The credit agreement is just the terms of the loan that also must be signed. Then there's a loan consent form. It does not have to be signed. You can say no. Loan consent is not getting the loan. Loan consent is lending your shares out to short sellers. You can go, I don't want to do that. There's not a big downside to it, but you can just say no. So hypothecation and credit agreement have to be signed. That's all in the margin agreement plus the disclosures. The loan consent, you can say, no, I don't want my shares lent out to short sellers. Okay. A debit balance and a credit balance. In a margin account, the debit balance is the amount of the money the customer owes to the broker. Remember, we bought share, we put money down, we borrowed the rest, we borrowed it. That's debit balance. The credit balance in a short account, when you short stock, is the cash proceeds from the short sale plus the margin collateral. What the fuck does that mean? Okay, now, if I short $10,000 worth of stock, that means I'm selling your shares. Somebody paid me 10 grand for the stock. I have to deposit 5 grand of my own money on top of that. So I now have 15 grand in the account. So again, credit balance is the money I get from selling the shares plus my own 50% on top of that. That's a credit balance. For a short sale, the credit balance is held by the broker as assurance that the shares can be repurchased. And the reason we do that is if I short shares for 10 grand, I have to deposit 5. This way, if the stock goes up, they know that there's money in the account to buy the shares at the higher price. Pattern day trader. Under FINRA rules, a customer executes 4 round trips, day trades, opening and closing the position in 1 day in 5 days. So I go 4 round trips in a 5-day period. They are designated a pattern day trader. Pattern day traders are subject to special requirements, including a minimum equity of $25,000. Plus, they can have an increased buying power, 4 times the maintenance margin. Now, if equity falls below 25 grand, you can trade still. You just have to wait for your shit to clear. The whole point of pattern day trading, remember, shit settles T+1, right? So if you buy shares today, the money doesn't clear till tomorrow. But as a trader, a lot of times when you sell stock, the broker-dealer will say, okay, we know the money's coming tomorrow. We'll let you buy using that money. So if I buy stock at 30 and then sell it at 50, I have $50 in my account by selling it, the broker-dealer will let me use that $50 now. But once I do 4 trades in a 5-day period, my wife's home, I will not be able to do that unless I have 25 grand in the account. If I don't, then they make the money has to clear before I get it. Okay, good stuff. I'll be back in a minute. Okay, now discretionary account. This is like the manna from heaven, right? So discretionary account is a brokerage account in which the customer is given prior written authorization via power of attorney or trading authorization to a registered rep or anyone to make trading decisions on the customer's behalf, such as what to buy, sell, the quantity, or the security, without requiring specific client approval for each trade. Firms must have a client signed discretionary agreement before they do it in paper, in writing. And every discretionary trade must be marked as a discretionary used or not on the order ticket. Representatives have a duty to only make trades suitable for the client's objectives. All discretionary accounts are subject to frequent supervision, usually at the end of the day, by the broker-dealer or the registered principal. Now, what does that mean? So discretionary order means that if I give you discretion, that means you can do trades on my behalf without getting shit ahead of time. If I give you power of attorney, you can choose everything. Now, don't confuse that with a not held order, where if I call you up and say, buy 1,000 shares of Microsoft, not held. I, the customer, I chose the amount, I chose the action, and I chose the asset. You're just choosing time and price. Boy, NVIDIA's getting killed. You're just choosing time and price. You don't need power of attorney. You need power of attorney or discretion if you're going to choose anything more than just the time and price. Like if I call you and say, buy 1,000 shares of a bank stock, if you're choosing the stock, then you need power of attorney. If I say, buy some IBM, you're choosing the amount, you need power of attorney. But if I say, buy 1,000 shares of Bank of America, pick the price for today, you're good. Also, that kind of not held order only lasts for the day. Discretion is whenever you do a trade, that's fine. It's good. Now, if you're going to put me in a limited partnership, remember that. If you're the rep and you have a discretionary account and you're going to put me in a limited partnership, you actually need written permission ahead of time because it's a whole different, there's a lot more risk there. Now, there are different types. Remember, power of attorney for the most part ends at death, revocation, when you turn it back, you turn it off, or if you become mentally incapacitated, like a Democrat. No, I'm totally fucking around. If you become incapacitated, coma, stuff like that, it ends. Or if you die, or if you revoke it, it ends. The only one that doesn't do that is called durable. Durable will always, by the way, all power of attorney ends at death no matter what. No matter what it is, at death, it's over. If you have durable power of attorney, then even if I'm incapacitated, coma, Democrat, whatever it is, I'm just fucking, don't come at me. It goes through that. It keeps going. Okay, it'll keep going until I die. Now, there's one other one that's showing up in the test called springing power of attorney. Springing means you have power of attorney only if something happens. So if I'm doing a trade, if I'm normal and I give you springing power of attorney, then that means you don't get it till I become incapacitated. Usually give it to like a daughter or a son or something like that. Like if I'm getting older and I'm worried about going nuts, because I mean, although the way I talk, you would never know. But if I become incapacitated or coma or something mentally diminished, then and only then does your power of attorney kick in. It kicks in when something happens, not until. And that is starting to show up. That's a nice thing to put on an account. So this way, if you know something happens, there's someone who can take care of it, but can't touch your goddamn money till that happens. Okay. A wrap account. It's a type of an investment account where a single fee, usually a percentage of assets like 1, 2, 3%, is charged to cover both advisory services and trading accounts, trading costs. In a wrap account, an investment advisor may manage a portfolio, potentially using multiple managers like wrap sub-advisors, and all the commissions are wrapped into one fee. Now, if you are a Justice Series 7 and you have a 63, you can't do this. This is an investment advisory product. So if you're a broker dealer, you need the 65 or 66 also, and you need to be under an IAR or an IA actually to be able to do this. So broker dealers can't do the wrap accounts. They can do fee-based trading, where you just pay one set fee for all your trades. But this wraps in both trading and advisory services. You must be an IA to do this. Schwab tried to do it like 15 years ago. They got slapped down like a bitch. So point is, if you want to do a wrap account, you need to be a broker dealer and an IA. And in reality, I think you could be an IA only and then outsource the commissions, but you cover them. But let's go for this test. You need to be both a broker dealer and an IA at the same time. You need the 7 and the 65 or 66 in addition to the 63 to do wrap accounts. Now, as far as wrap accounts go, normally you would only do this if someone trades a lot. You can do it, you get assets. But like these wrap accounts, if someone trades like once every 2 months, why bother? Don't do that. It should be worth it if you're going to trade more. That's usually one of the things that you want to see, that they're an active trader and that this would save them money. Okay, not too shabby. Primary markets next. Okay, so I want to talk about trading markets and order types and stuff in the bid and ask, but I want to talk about first, we have to cover this. The primary market versus the secondary market. Primary market, I'll give you the definition, but is when the issuer raises money, like when a company is looking to raise money to, whether it's a bond or stock or whatever it is. That's the primary market. The issuer is getting the money. So the primary market is the market where new securities are sold by the issuer to investors for the first time. That's an IPO, and then every additional one is still the primary market. IPO means first time. Additional or follow-on means doing the same thing, but over and over again. In a primary offering, the proceeds of the sale go to the issuer. The Securities Act of 33 governs primary market offerings, requiring registration of securities and delivery of prospectuses to purchasers unless an exemption applies, which I talked about earlier in the video. Underwriters typically facilitate primary market transactions. Secondary market, that's the trading shit, right? Covered by the Act of 34. Market where investors buy and sell securities with each other and not with the issuer. This includes trading on exchanges and in the over-the-counter market, which is like pink sheets, OTCQX. The Securities Exchange Act of 34 governs secondary market trading and established the SEC to regulate exchanges, broker-dealers, and ongoing reporting by the public companies. So when a company goes public with the SEC, they have to do certain reports like a 10Q, a 10K. A 10Q is a quarterly, you're welcome. 10K is an annual report, and an 8K is like in between when they make a special announcement. When you buy Apple stock, a stock on NASDAQ, for example, that's a secondary market transaction. Apple receives no proceeds. The other investor or the market maker is the other side of the trade. Okay, so what are exchanges? They're centralized marketplaces, physical or electronic. New York Stock Exchange is physical, sort of hybrid. NASDAQ is kind of in the ether, where securities listed on the exchange are traded by members or participants. The New York Stock Exchange is an auction hybrid market with a specialist list, DMM. Now, that the DMM or the specialist job is to match buy and sell orders and maintain an orderly market, while NASDAQ is a dealer market with many market makers electronically quoting prices. So the New York Stock Exchange has one market maker per stock, and they can have multiple stocks, but one market maker, a DMM per stock, and they match buyers and sellers and try to maintain an orderly market. This NASDAQ has multiple market makers, and just by pure volume of market makers creates an inside market, which is the highest bid and the lowest ask. We'll get to that. Exchanges have listing standards and provide transparency and liquidity for secondary trading. Listed securities can be traded on multiple venues due to Reg NMS, but the primary listing exchange where most price discovery occurs. We find it over the counter, a decentralized market where securities not listed on exchanges are traded through a network of broker dealers. So it's broker dealers, Goldman buying from JP Morgan, and Jefferies buying from Goldman, and Jefferies buying from Pershing, or whatever it is, all different companies. Okay. The OTC market, now just I guess it's called off exchange, but I don't give a shit, handles securities like many corporate bonds, most bonds, munis, treasuries, and small cap stocks. OTCQX or pink sheets they trade over the counter. Prices are negotiated via phone or electronic system between dealers. NASDAQ, while an exchange now, started as an OTC quotation system. So we have OTCQX and the pink markets, pink sheets, whatever you want to call them. They provide venues for quoting, but still they trade with each other. And when you report something on NASDAQ, you use TRF, Trade Reporting Facility. And when you quote something over the counter, a pink sheet, it's ORF. That's how we report the trades. But again, over the counter, the pink and the OTCQX is not execution. They just showed the bids and asks, and then we trade. Speaking of bid and ask, in trading, the bid is the highest price a buyer is currently willing to pay, and the ask of the offer is the lowest price is willing to sell. The difference between the bid and ask is called the spread. For example, if a stock quoted is quoted at 20-10 by 2020, an investor selling would receive 2010, and one buying will pay 2020. So again, I have a video on this, the bid and ask. The bid is the highest price anyone's willing to pay. The ask is the lowest price anyone's willing to sell it at. That's a snapshot. So 2010 by 2020 means the highest price anyone's willing to pay is 2010. The lowest price is 2020. If you want to buy stock, you have to pay. You have to buy it where people are selling it. So you have to buy it at the ask. If you want to sell stock, you have to sell it where people are willing to buy it, which is the bid. So remember, you buy at the ask and you sell at the bid. What confuses people is that market makers, they say market makers buy at the bid and sell at the ask. Well, they're more likely to, because market makers are the ones bidding and offering. So if I'm bidding 2010, there's a chance a seller will come in and hit my bid. And if I'm offering at 2020, there's a chance a buyer will come in and take my offer. So I'm more likely to buy at the bid or sell at the offer, but there's no guarantee of that. If I really want to buy stock, I have to pay the ask or sell at the bid. The spread often represents the market maker's profit for selling a trade. So if I'm a market maker, I bid 2010, I'm offering at 2020. So if I get to buy stock at 2010 and offer at 2020, that's my profit. Mark up, mark down, and away. A market order, in order to buy or sell a security immediately at the best available current price. A market order guarantees execution, assuming there's trading, but not price. So again, market order is just buy the stupid thing. Buy or sell it, I don't care about price. For a liquid stock, a market buy will typically execute at the current ask price and a market sell at the bid. I just said that. Market orders are appropriate when the primary goal is getting the trade done quickly and the trader accepts the prevailing price, meaning that if I place a market order, I'm just saying buy or sell the thing. I'm not worried about price. We can add a little nuance to this. A market not held order is not done immediately. If I call you up and say, buy 1,000 shares, do the best you can, and you say you're not held, I'm letting you sit there and try to buy and sell or buy it or sell it. And you can wait. Like, so if I say buy at the market, you have to do it right now at the ask or sell at the bid. But if I say not held, you can let it trade and see if it's going to come down or go up. You can try to get a better price from me, and I'm not going to yell at you. I will probably yell at you anyway. But in theory, you're not going to get in trouble for not buying or selling it right away. You're trying to get a better price for me. A limit order, in order to buy or sell a security at a specific price or better. A buy limit order specifies the highest price the investor is willing to pay, and it will only execute at that price or lower. So if I say buy 1,000 shares at 20, I will buy it at 20 or lower. If I say sell 100 shares at 20, I will sell it at 20 or higher. So if I say buy 100 shares at 20, I will not pay 20.01. I will pay 20. I can change my mind, but I'm not willing to pay more than that. I'm putting a limit, a budget on what I'm doing. Now, limit orders guarantee price. You won't get worse than your limit, but not execution. So market orders guarantee execution, but not price. Limit orders guarantee price, but not execution. Now, there is called a stop order, what they call a stop loss, okay? A stop loss order is this. I own stock at 50. I'm worried the stock is going to drop. So what I'm going to do is I'm going to say, listen, I own it at 50. If it gets down to 45, sell it. I've already lost $5. I don't want to lose any more. That's a sell stop. An order that becomes a market order once a stop price is reached. So if I say sell it at 45, just get me out of it, stop the bleeding, stop the pain, get me out of it. I'm going to say it's trading at 50. I'm going to say to you, sell 100 shares at 45, stop. That means the order goes in and now it's there. I'm willing to sell it once it trades at 45 one time. It'll trigger, then trade. So remember, stops protect, limits don't, right? So a stop order needs to trigger and then trade. A limit order just trades when it gets to the price. So let me go back to the definition. A sell stop limit to limit the downside loss is placed below the current price. If the stock trades at or below the stop price, it triggers and the order turns into a market sell. Remember, so stop orders turn into market orders when it gets down to that price. A buy stop, often to protect a short position or to buy in a breakout, if you want to say, is placed above the last sale, current market. And what happens is if the stock gets up to that price, it's going to trigger and become a market order. Now, the actual fill price, you don't know. Once it triggers, you do not know what the price is going to be. It could be the last sale. It could be higher, lower. It could be anywhere. So a buy stop, once it gets up to that price, it's going to trigger, turn on. That's what she said. And it'll be at the next price no matter what. If you do a sell stop, when it trades down to that price, it's going to trigger and then become a market order. If you want more information on that, go on my channel, look for the search button, and type in slobs over bliss. Bliss, I can't speak. Slobs over bliss. SLBS/BLSS, and that'll give you a better idea of it. Now, I can be a jerk and go in all or none order, which means I want to buy all of my shares or buy none of them. So I call you up and say, I want to buy 5,000 shares at 30, all or none. That means I'm going to put it out there. I want to buy all that 1,000 shares at 30. I said 1,000. But I will not accept less than that. So I'm saying I want to buy 1,000 at 30, all or none. If somebody comes and says, I'll sell you 900, I go, no, I buy all of it or none of it. So again, all or none order, a directive on certain orders, usually limit orders, right? Meaning the order should only be executed if it can be filled in its entirety. I will not accept a partial fill. All or none orders are not displayed because you can't really tell that, okay? Now, they remain active until they can fully execute or until they expire, which end of the day. Now, here's the thing. If you place an all or none order, it's good till the end of the day and then it cancels, okay? Now, the other one is called an immediate or cancel, which means buy as much as you can right now at a price and cancel the rest. So again, a type of order, instruction requiring that all or part of the order be executed right now. If any part that's not filled, is it canceled? So it does not wait on the book. If you give an IOC to buy 10,000 shares and you only can buy 6,000 right now, boom, you buy the 6,000 and then you cancel the 4. Good, I like that. Most orders are day orders. If you place an order, a day order, you're buying it, and that's going to expire at 4 p.m. Now, you can do a system day, which closes at 8, but let's not go there. A day order means I'm buying it. I want to buy stock at a limit, and I want it to expire at 4 p.m. If you don't say anything, it's assumed to be a day order. 99% of orders are day orders. Now, they also have a good till cancel, which means I want to buy stock at a price, but leave it out there until you cancel. Usually there's like every May and November, they recheck to make sure you want to do this. But good till cancel is good until I cancel it. GTC, good until I cancel it. So I want to buy it. I want to buy it at 42. And you can, if I don't say anything, it ends at 4 p.m. But if I say good till cancel, that means I leave it out there for as long as I need it until it's canceled or until I buy it. So they keep going across day by day by day by day. Now we're going to get to level 1, level 2, and level 3 quotes. These are levels of market detail. So let me give you the definition first. Level 1 shows the basic bid and ask with the size and last trade, the NBBO, National Best Bid, Best Offer. That's what that is. NBBO is the inside market, the highest bid and the lowest ask in the world. Okay. Level 2 quotes display the depth, means the bids and asks from each market maker exchange. 5 or 10, you're going to see 5 or 10 levels, but you might see all of them. I'm going to put a picture of, giving insight to the supply and demand beyond the inside market. Level 3 is for market makers. It looks just like level 2, but you can also enter and take out quotes. So let me put a screen up here. Let me show you what it looks like. Let's do this. Okay, here we go. So this is what a level 2 looks like. Now, right here in red, this is the best bid, that's the highest bid. And look, this represents all of these people, 10,000 shares to buy. Here's the best offer. These are all these people offering. Now, when I say people, I mean market makers. These are really ECNs, but the idea is that these are market makers buying, these are market makers selling. This is the inside market. So if this goes 44, then 45. So, hold on, I'll be back. Okay. So I think I did some of this. I'll do it again. So level 1 is just the bid and the ask and the amount. So in this case, it's 39.43 bid for 11,000 shares. It'll change because this changes. And then 2,800 at discount at 39.44, the highest bid, the lowest ask. Now level 2 shows all the bids behind that and all the bids behind that. So what happens here is that this is 43 bid. These are all the market makers. It's really ECNs in this case, but the market makers are down here. These are all the, let's say for lack of a better word, the market makers bidding. These are all the people willing to bid 43 cents, 39.43. And then behind that is a 35 cents, 26, 38 cents, all the bids behind it. So all of these bids go away. Then this becomes the best bid, the next one down. And then this is level 2. You get to see all the people buying and selling outside, trying to buy and sell outside of it. Now in the offer, here's the best offer. This is all the 44 stuff, the blue. And then the one after it is a 39.45 and 48 and 39.50, all the way out. So again, the best offer. And then these are the next ones following it. So this is a level 2. Now level 3 looks exactly like this, except for you can actually enter quotes. That's all it is. So NBBO is the national best offer. That's it right there. Highest bid, lowest ask in the whole world. This, and then level 2 shows all the other bidders and the people offering that are hot, that have worse prices than we're doing. Dark pool, a private securities trading venue, often operated by broker dealers. Usually, it's a broker dealer running this, and it's like private. It's hidden shit. Where investors, typically institutions, usually it's institutions or not usually retail people, they can trade large blocks of stock anonymously without revealing the order to the public. Dark pools do not display quotes or the trades. The trades are reported to the tape after the execution, then it does show up, but not when it happens. The advantage is to avoid moving the market price for large orders. The disadvantage is reduced transparency. Regulators monitor dark pool activity to ensure fair trading and prevent its use. So understand, a dark pool has, like, the best way to explain it, a dark pool, like you're bidding and you're bidding and you want to buy something, you put it in a dark pool, you have no idea if there's someone selling it at the same price. But if you want to buy stock at 40 and they want to sell stock at 40, boom, it matches up and happens, but you have no idea. It's almost like shooting in the dark, pew in the dark, and maybe hit something. That's literally what it is, okay? That's all you're doing is putting a bid in, somebody else puts an offer in. If they match, it works. If they don't, you cancel and you move on. So you don't really ever know who's buying or selling. You won't see what happens on the tape until the trade happens. You could say, hey, I'm going to try to buy 50,000 shares at 42, throw it in the dark pool and go, boom, I bought it all. You had no idea there was a seller, but he was there in the dark, in the dark. Okay, the tape, the consolidated tape, that's the thing you see crawling. When you watch CNBC during market hours, you see the prices go across. That's really the consolidated tape. So it's an electronic system that reports the latest price and volume data on sales of exchange-listed stocks, regardless of the exchange or venue. So the consolidated, they bring them all together. New York Stock Exchange, AMAS, NASDAQ, they're all on there. They consolidate the trades. When a trade occurs, it is printed to the tape with the price, volume, and possibly where it is, but they're not going to say that. So let's just go with the tape. When it goes on the tape, it's going to show up with the price and the volume. How much traded at what price? The tape provides real-time public disclosure of trading activity, promoting market transparency. So you do a trade. When you do it, like say we do a trade, you have 10 seconds to report it through TRF. It goes into the ACT system, and then boom, it shows up on the tape, and it shows up below CNBC. Now, no, understand, trades go so fast that what you're seeing on CNBC isn't really the actual every single trade that happens, but they have rules like, only trades over 500. Everything's reported, but you're not going to see it on that ticker tape. Okay, trade settlement. Remember, this is T+1 for everything. Everything's T+1. The process by which a traded security is delivered to the buyer and payment is delivered to the seller. So again, when you buy shares or sell shares on Tuesday, the buyer's broker-dealer will send the money, and then the seller will send the shares. And that happens T+1. Do not confuse that with payment date. Payment date is you actually have T+3 or settlement +2. That's Reg T payment. So when you buy stock on Monday, you have until Thursday to pay for it. But it's going to settle on Tuesday, which means the broker-dealer is technically lending you money for 2 days. So everything settles T+1. Now, that's regular way settlement. Now, cash settlement is the same as same day. They settle by like 2:30. There's also a thing called seller's option where you sell it and you go, look, I'm not going to be able to deliver it on T+1, but anywhere between T+2 and T+35, I'm going to deliver it. Maybe there's a legal holdup. Maybe something happened. Maybe a divorce isn't final. Maybe I can't get to it, whatever. I won't be able to deliver it. And if I do that, it's not like the buyer gets surprised. They're told, if I do seller's option, the buyer has to be like, okay, I'll buy it with that contingency. Now, once it settles, you are now considered the owner. You buy the shares on Monday, you can sell them right away. So you bought them, but you're not on the record books as an owner until T+1 or whenever it's settled. But we're going to say T+1 because that's normal. So again, when you buy shares, you're not the owner. You're the owner, but you're not on the record as an owner until the next day. Cash settlement happens the same day. Now, if a trade does not settle because one party doesn't deliver or get it, it's called a fail to deliver. And it can result in buy-ins or closeouts, which isn't going to be on a lot of these exams. A DK notice, that's a don't know. So basically, it's a message sent between broker-dealers when there's a discrepancy or unrecognized detail in a trade contract. So if I buy 1,000 shares at 42 from you, and then I send the confirm that night to you, and I say, I bought 1,000 shares at 41.99. You're like, I don't fucking know that. So you send me back a DK and say, Ken, what are you doing? So a DK is, I don't know what you're talking about. So if I call you up and say, I bought 1,000 shares at 42, we agreed. I send it to you, it's either 1,200 shares or 900 shares or wrong price. You're going to send back a DK to say, listen, if something's wrong, let's fix it. Okay, riskless principal trade. So, okay, we didn't talk about this. Agency versus principal. Okay, an agency trade is when you're acting as a broker. Remember, ABC, agent, broker, commission. ABC means that you're acting as an agent. I'm a middleman for you. So if you give me an order to buy 1,000 shares, I'm going to take the order and take your order and go buy 1,000 shares from a seller and then say, oh, you bought 1,000 shares at 42 plus a 50-cent commission. Remember, agent, broker, commission. So if I act as an agent, I'm going to charge you a commission for doing the trade. I'm a middleman. I'm stepping in your shoes to give it to you and then give you the shares. Principal is I actually sell it to you. So if you give me an order to buy 1,000 shares at 40, I will sell it to you at 40 plus a little bit of a markup, like 50 cents. So you say I want to buy 1,000 shares at 40, I'll go, fine, I'll sell it to you at 40.50 plus a little bit of a markup. Now, that's principal trade. Now, there's a riskless principal trade. A riskless principal is where instead of me using my own inventory to sell it to you like I did in the principal trade, I am going to do that, but here's the difference. With a regular principal trade, I own the shares and they can go up or down. I have risks that I could lose money or make money before I even get your order. Well, a riskless principal, I don't place the order until you give it to me. So you call up and say, I buy 1,000 shares at the market. I will then go buy 1,000 shares at 40 in the market. That trade gets reported, and then I'll turn around and sell it to you at 40.50. And that's with the 50-cent markup. That doesn't get reported. Now, remember something. That is riskless principal because I'm not actually buying the shares until you give me the order. Now, the other side is a sell. So you give me a sell 1,000 shares. I have to do it slow. I will then sell the shares out of my own inventory. I will short them at 40, and then I'll buy it back. And that shows up on the tape, the 1,000 shares. And then I will buy your shares from you at 39.50, which is really 40 minus a 50-cent markup. Now, when I do this, I will disclose the markup or markdown. I have to disclose what I charge you as a markup markdown. Then we have what they call a net basis trade. A net basis trade is almost the same thing, but I don't disclose the markup. It's really two trades. You give me an order to buy 1,000 shares at 40. I buy, or whatever price, buy 1,000 shares. I buy 1,000 shares at 40, that shows up at the tape, and then I sell you 1,000 shares at 40.50, but I just say you bought them at net 40.50. I don't say that I charge a 50-cent markup. I just make the profit between it. So again, you give me an order, I buy it at 40, I turn around and sell to you at 40.50, and I don't disclose the markup. I just say, hey, you bought your stock at 40.50 at a net price, and then you're fine. So that's a net basis. Now, the problem is there's a chance for abuse because I'm not disclosing anything. So if you're an institution like a broker-dealer, hedge fund, when you open the account, I can do what they call a negative consent and say, hey, I do net basis trades. If you're okay with it, don't say anything. If you have a problem with it, let me know. And if they don't say anything, we're good. But if it's a retail customer, I have to get permission every single time I do it for you. So if you call me up and say buy 1,000 shares, and I'm going to do a net basis. I go, by the way, I'm doing net basis. Fine, write it down. We're okay with it. Then I do it and sell it to you because it's really a chance for abuse because I'm not showing you the markup markdown. But institutional traders know where it's trading. They know if you're ripping them off or not. Okay. Now, remember that I said ABC, agent, broker, commission. The other acronym is PDM, principal. If you're acting as a principal using your inventory, you're acting as a dealer and you charge a markup markdown. Sometimes I say PIDM, PIDM, principal inventory. You're using your inventory, dealer markup. Okay. Stopping stock, which is, we'll talk about it. But stopping stock is if I'm a market maker or a designated market maker usually, and you give me an order to buy stock, I'll say, listen, you're stopped at 40, which means you're protected. That means if you want to buy shares at 40, and it can only be done to public orders, I can't do it to a broker-dealer. I am a broker-dealer. You have to be the public. You give me an order to buy 1,000 shares at 40, I'll say, listen, you're guaranteed 40. Don't worry about it. No matter what happens, go try to do better. Don't go with me. Go somewhere else. Try to buy it at 39.80 or 39.50 or 39.90. And if you don't buy it there, come back to me and I'll sell it to you at 40. So I'm kind of protecting you at a price. That's called stopping stock. Program trading, in case you want to know, program trading is like algorithms where they just use computers to buy shares of like an ETF, and then they actually short the ETF and buy the shares, or they short some sort of basket of stocks, and then they buy the actual stocks. They capture the difference. Program trading is trading with an algorithm. They're trying to capture little differences in the market. Trade reporting facilities. So any trades that you have done on NASDAQ, well, any trades that are done on NASDAQ could be reported through TRF, trade reporting facility. If you do a trade ORF, and I think we talked about it, if you do a trade at ORF, over the counter, you can use ORF. I buried that. Okay, ECNs. These are electronic communication networks, ECNs. They are platforms that allow direct trading of exchange-listed securities. What that means, there's a platform. Remember something. If you are a hedge fund or an insurance company or a mutual fund, and sometimes they're broker, if you're not a member of NASDAQ or FINRA, you can't trade on the exchanges or over the counter. So they created an ECN, which is an electronic format. The electronic platform, usually it's owned by broker-dealers or some sort of an exchange. And they allow institutions that are not members to trade with each other. Anyone can trade on these. These are 24 hours, allow you to trade outside the hours, but you can trade anytime you want. It's agency only. So you place an order on the ECN. If there's a seller, if you want to buy stock on the ECN, you place it in there, a limit order. If someone's selling, they'll sell it to you and you do the trade. If you want to sell it and you put an order in, if someone's buying, they'll buy it from you. Some ECNs are dark pools, some are not, but ECNs are electronic platforms that allow trading between dealers, non-dealers. Now, broker-dealers can use it, but it was originally set up to allow institutions to trade with each other without actually dealing with the broker-dealers and the salespeople. Okay, the gray market. That's actually very cool. The gray market, it used to allow a lot of people to trade it, but now when a stock's going through its IPO process and it hasn't been traded yet, they haven't come up with a price yet, the gray market allows, it's not a black market, a gray market, so it's a gray area. It allows institutions to trade a stock before it's listed. And they allow that because institutions will determine the price because they're buying here, they're selling there. And like you say, you thought I bring the IPO at $40, but all the institutions are trading it at 38. Well, that's probably the better price. So the institutions are using their math to figure out what it should be trading at. So the gray market does help with transparency, getting the right price. But retail people cannot trade on that. Okay. Now, a trade reporting error. So if you give me an order to buy 1,000 shares and you actually buy it at 20, and by mistake, I tell you, oh, hey, John, you bought it at 19. I give you the wrong price. I have to call you back and say, by the way, you actually did it at 20, and you have to accept that because that's what price you really did it at, okay? That is a reporting error, and that's on you. The customer has to take the price they really did it at. You can't refuse it. Now, a execution error is on me, the rep or the broker dealer, and it's going to go in my error account. That's where you give me an order to buy stock at 20, I buy it at 21. Not your problem, it's mine. Or you give me an order to buy 1,000 shares, I'll buy 1,200. Well, the 200 is on me, that goes into my error account, not the customer. Or you give me an order to buy and I sell it by mistake. All these things have happened to me and other people. When I trade on the stock exchange, I mean, you're trading so fast, you have 2 phones, sometimes 3 phones, and you're writing stuff down. Sometimes you make mistakes. Those are called errors. The execution errors go into the broker dealers, not the reps, error account. And then the rep and then the customer doesn't have to pay for that. Okay, clearly erroneous trades. Now remember what I tell everyone, I should say this. I talk fast, so slowly sit down. I'm into like the 3rd hour now. It's like, oh, okay. I'm going to try to break it up first and then give you one big ass fucking video. So clearly erroneous trades is like, it happened like the flash crash like 15 years ago in 2009. When you place a bad trade, like say you go to buy say a stock's trading at $20 and you put an order to buy it at 200 and it runs it, like it runs outside a certain parameter. Depending on the price, I'm not going to go into the numbers, it's like 10, 15, 20%, depending on how busy the stock is and what it's trading at. But if a stock moves very quickly into that outside this range, you can, within 30 minutes, you can report to NASDAQ and say, hey, this is clearly an error, a wrong trade. And then the exchange can bust the trade, which means avoid it out. But there are rules. You have to do it within 30 minutes, and they have 30 minutes to come back to you. And then if you don't like the answer, you have 30 minutes to appeal. But again, you place a trade. Like the big one is, I give you an order to buy $1 million worth of Merck. And you place $1 million, you go to sell. Do I want to tell you to sell $1 million worth of Merck? And you sell 1 million shares, which could be like $30 million worth. That could cause the price to drop. And that's kind of what happened 15 years ago. The price dropped like down 50 points and everything just went crazy. So now, if they determine that it's a clearly erroneous trade, like it doesn't make sense, it's substantially outside the normal range, you'll apply for it, they'll avoid the trade, and then it acts like it never. Again, in the whole settlement thing, failure to deliver is when a seller doesn't deliver the securities by T+1 or whatever the settlement is at the time. So arbitrage, it sounds illegal, but it is. So not arbitration. Arbitration is when you have a dispute and there's a 1 to 3 member panel that decides who's right. And it's binding, you can't appeal it, stuff like that. And if you work at a firm, you have to agree to it. Customers don't have to agree to it, but they can head it. Now, Duke wins. Okay, beats Alabama. Am I still in? I think I'm still in. Now, the next point is arbitrage. Back to this. It's my diatribe. So, it's not diatribe, not the word. Diversion. I'm an idiot. Okay. So arbitrage is when you capture differences in the market. So there's different types, right? And I want to do a video on this one because I think it helps because people think it's illegal. Arbitrage is when you find like a difference in the middle. So let's say back when I was first worked on the exchange in the 90s, everything was mortar and pestle kind of thing. Okay, tablets. I need Houston to win, baby. Now, I don't know if they're out of it yet. So now, I'm going to, if I see IBM trading at $60 in New York, but then I look on San Francisco, it's trading at 61. What I could do is remember, arbitrage is 2 things at the same time. I will buy the shares in New York at 60 and the exact same time short the shares at 61. And then since I'm shorting it, I'm selling something I don't own, I have to buy it back at some time, but I bought it already. So I use the buy to collapse the short, to cover the short, and I make $1. That's arbitrage. You're doing it at the same time. Arbitrage is always doing something in 2 different markets to capture the difference. Now, again, now the computers are on, it's within pennies. I'm showing $1. So again, it's trading at 60 in New York and trading 61 in San Francisco or the Midwest or Boston. I'm going to, exact same time, I'm going to place an order to short it at 61 and buy it at 60. And then I make the $1 difference. That's one way. Convertible arbitrage is, you should know this already, when the bond is profitable to convert, which means if you turn it into common stock, you'll make money. What people do is they'll buy the bond and at the exact same time short the shares. So now you're short the shares, you have to buy them back, but all you have to do is convert your bond into shares and that'll pay it off. So if the bond is trading at 104 and parity on the stock is 106, you'll buy the bonds at 104 and short them the proper amount of shares at 106, and then boom, you collapse it and you make $2. People also do it with mergers and stuff, like they do it with foreign trading, like stocks here versus London. The currency change makes it, you can do all this stuff. So currency arbitrage, it works. Merger arbitrage is like what happens is if I go to take over a company, say my stock's trading at $100, and I say, I'm going to give you one share for every two of your company. So your stock's trading at 51. My stock, let's say your share's trading at 49, my stock's trading at 100. So I'm going to say, for every two shares of your stock, I'm going to give you one of mine. Okay. What I'm going to do is I'm going to buy two shares of the target company for $49 each. That's $98. And then short the takeover company at 100, and then make the $2. I literally did that for the first 2 years of my business. So again, I'm going to take over your company. It's usually not with a cash deal. It doesn't work. So if I'm going to do like a stock deal where I got to say, listen, your stock is trading at $49. My stock is trading at 100. I'm going to take you over, but for every two shares you have, I'll give you one of mine. So if though your two shares are less than my one share, you'll buy the target shares and sell the acquirer, short it, and then collapse it. And if it goes the other way around, you keep going back and forth. A lot of confusing stuff, but just understand, merger arbitrage is a thing, convertible arbitrage is a thing, currency arbitrage is a thing. By the way, merger is called risk arbitrage because if it goes bad, it goes bad. Stock arbitrage, and that's kind of it. Regular just arbitrage. Now we're doing the big regulation, stuff like that. Okay, here we go. The Act of 33, the first federal securities law, the Truth in Securities Act, it governs the issuance of new securities, the primary market. Its two basic objectives are to require that investors receive full and fair disclosure of material information about securities being offered to the public and to prevent fraud in the sale of new securities. The Act mandates that most new issues of securities be registered with the SEC unless you have a Reg D, a Reg A, Rule 143, 147, any kind of exemptions. The Act of 34, the law, that's why I use MISPERMS as an acronym for this, but it's all about the secondary market and broker-dealers. The law that established the Securities and Exchange Commission and governs the secondary market trading of securities. So again, Act of 33 is the first act, so it's primary. Act of 34 is the second act, so it's a secondary market. It regulates broker-dealers, stock exchange, and requires public companies, and again, I've done this, to file 10Qs, which are quarterly reports, 10K, which are annual, and 8Ks, which are in between. Its mission is to maintain a fair and orderly market and prevent manipulation. Key provisions include insider trading precision, proxy, which is voting by mail. Okay, the Maloney Act of 1938. It's an amendment to the Exchange Act of 34 that allowed SROs like NASD and eventually FINRA. That's all it did. The Investment Company Act of 1940 regulates investment companies, which is mutual funds, closed-end funds, UITs, ETFs. So remember FUM, F-U-M, face amount certificates, unit investment trusts, management companies. It requires investment companies to register with the SEC and have a defined structure, board of directors, custody, limitations on margin and all that. And they have to have filings and reporting and fee structures. The act is designed to protect investors by ensuring disclosure and conflicts of interest. Unfortunately, the same year, the Investment Advisors Act of 40. This federal law regulates investment advisors, federally covered investment advisors. Again, the Investment Advisors Act of 1940 is a federal law. Unfortunately, it's the same year, and it sounds just like the Investment Company Act. So Investment Company Act, think mutual funds, Investment Advisors Act, think advisors. The federal law that regulates investment advisors. These are firms that provide securities advice for compensation. Remember, broker-dealers execute for compensation. Advisors give advice for compensation. It requires certain advisors to register. If they have assets under management over 110, they got to register federally. And if they're under 100, then they will probably register at the state level, not the federal. The act imposes a fiduciary duty on advisors, and they have to abide by ethical and disclosure obligations. It spells out there's exemptions like banks, publishers, stuff like that, government securities advisors, things like that. So remember, you as a Series 7 rep are not an investment advisor. You are probably an agent or an IIR, not an investment advisor. But an investment advisor, if you work for them and just them, you need the 65, and you're an IIR. If you want to charge fee-based accounts or just charge for financial planning, you need to be an IIR, not a broker-dealer. Remember, broker-dealers charge commissions for trades. IAs can charge wrap fees and management fees for not even doing trades, just giving advice. So FINRA is an SRO for U.S. broker-dealers and their associated persons. FINRA was created in 2007 when they merged NASDAQ and New York Stock Exchange. FINRA writes and enforces rules governing ethics and business conduct of broker-dealers, brokers, and it administers the Series 7. And it actually oversees the dispute arbitration, stuff like that. It operates under the SEC. Remember, the SEC is the government, so the SEC has to approve any new FINRA rules. On that note, the SEC, the Securities and Exchange Commission, it's a U.S. federal agency created by the Act of 1934 responsible for enforcing federal securities laws and regulating the securities industry. So broker-dealers have to follow the rules, investment advisors, issuers of publicly traded securities, IARs, and agents all have to follow those. Now, agents and IARs don't register the SEC, but everything, all the entities do. It oversees exchanges, broker-dealers, clearing agencies, investment companies, and investment advisors. Now, the SEC has broad authority. It can bring civil enforcement actions, fines, and injunctions for violations, such as insider trading, accounting fraud, selling unregistered securities. The SEC also reviews required filings by public companies and can create new laws under securities law. Now, MSRB, it's an SRO that writes the rules for securities dealers. Well, it rules for the municipal securities market, muni bonds, notes, 529 plans, stuff like that. They write the rules for the broker-dealers and the advisors, not the issuers, because issuers of munis are states, so they don't have to follow the rules. Now remember this, the MSRB does not enforce. If it's a broker-dealer, FINRA or the SEC regulates them and enforces. If it's a bank, it's the Federal Reserve Board or the Comptroller of the Currency or FDIC that regulates them. Blue sky laws, these are written by NASA. Blue sky laws is like slang for state securities law that require registration of securities and licensing of brokers and IAs and agents and IARs in the state level. Even if federal laws exist, a lot of issuers and brokers and IAs have to comply with blue sky laws unless there's an exemption, stuff like that. So blue sky is all about the state registrations. So even if I have the 7, I still have to get the 63 or the 66 to be able to do business in the state. Then we have the oft forgotten Trust Indenture Act of 1939. It regulates a federal law that applies to corporate bonds over $5 million. It requires that a trust indenture, it's an agreement between the issuer and the trustee who's protecting the bondholders, be in place for the bonds. The indenture must specify the rights of the bondholders and obligations of the issuer. It literally says what the bondholders can do and what the issuer can and can't do. The trustee, which is usually a bank, is going to enforce those. If the bank defaults or does something wrong, the trustee will sue them into bankruptcy court. SIPC, run by the SIPA. So a nonprofit corporation created by the SIPA Act of 1970 provides insurance protection for customers of bankrupt broker-dealers. So again, this is not if their investments go bad. If the broker-dealer goes bankrupt like Lehman and Bear Stearns, they cover up to $500 per $500,000. That'd be crazy. $500,000 per customer, of which $250 can be cash. So it's not $750; it's $500,000, of which $250 can be cash. So technically, if you have $300 in cash, you're not covered for all of it. Again, SIPC does not cover losses due to market declines, or fraud. It's literally if the company broker-dealer goes bankrupt. It doesn't cover it only covers securities, and any broker-dealer has to be a member of SIPC. Now we have ITSFIA, which is Insider Trading and Securities Fraud Enforcement Act of 1988. Just say ITSFIA, it's all about insider trading. The act strengthened the penalties because a lot of Boski and Milken did this crazy shit. It strengthened the penalties for insider trading violations, which is trading on material non-public information. Remember, having inside information is not the crime. Acting on it is. It not only punishes the individuals who trade inside information, which is jail, and treble damages, which means you can lose 3 times your gain or the loss you avoided. Think Martha Stewart. She saved herself, $800,000 or $600,000 because she sold her shares before the stock went down. They fined her 3 times what loss she avoided. But this also imposes supervisory liability, which means if you're a supervisor of someone who trades on inside information, you could be in trouble if you didn't follow the steps. So they have a rule called known or should have known. So if you knew about the insider trading, yeah, you're done. But if you should have known it because you did what you're supposed to, then you'll get in trouble. So if you did all the stuff you're supposed to and it somehow got in the crack between the cracks, you're going to have a problem, but you're going to be fine. But if you fail to read a certain amount of emails or you forgot to follow up on something, then you can be in trouble for doing that. So that a Series 24 could be liable for one of their agents insider trading if they didn't do everything they're supposed to. Penny stock rules. Penny Stock Reform Act of 1990, federal laws to protect investors from abuses and what they call them low price over the counter stocks. Designated securities, these are penny stocks. A penny stock is a stock that is trading under $5 and over the counter or not on an exchange. So if it's on an exchange and $4, totally fine. If it's over the counter and over $5, again, totally fine. These rules apply to stocks trading under $5 and not on an exchange. So broker-dealers have to provide risk disclosure documents. For any new penny stock investors, they must have an approved signed suitability statement every time until they hit a established customer status. And they have to have a signed acknowledgement of the disclosures. Firms must also provide monthly statements showing the market value of each penny stock. And these are to probably slow down the Wolf of Wall Street stuff, that whole penny stock freeze. People get abused. The Telephone Consumer Protection Act of 1991. This is the do not call stuff, okay? This act and all the FCC rules, it restricts time of day restrictions for cold calling. So now, this is for cold calling, not warm calling. Warm calling is a client sent a card in, or they called you, or they're a client. These rules don't apply. So you can only cold call between 8 a.m. and 9 p.m. in the local time of who you're calling, not yours. They also have a do not call list. If they request, person you're calling requested you not to call them anymore, you must put them on a do not call list. I think it's for 5 years, but within 30 days kind of thing. So you cannot call them, okay? Now, if you call, because you're allowed to, you have to give your name, the firm's name, the telephone number, and the address. And charitable, don't have to follow any of these rules. So basically, all the Series 7 reps have to know these rules because you have to know to make sure you don't violate them. The Bank Secrecy Act of 1970, this foundation, U.S. Anti-Money Laundering Law, AML, requires financial institutions to keep records and file reports that are useful in detecting money laundering, tax evasion, and other criminal activities. Under the BSA, they have things like CTRs. So any kind of cash transaction, currency transaction report, any kind of cash transaction that goes in or out that's over 10 grand. So 10 grand's fine, 10,001 or 10,000 and a penny is over. So if cash goes in or cash comes out, you have to do a report. It's not a big deal. That probably thousands are done a day. It's just reporting it. Now, a SARS, a suspicious activity report, are for transactions that appear suspicious, usually 5 grand or more for the most part. And you have 30 days to report because you're literally filing that report with the Treasury Department or SEC or whoever who would be governing that. All broker-dealers must have an AML compliance program and an AML compliance officer, and training mandated by FINRA and the Patriot Act. The Patriot Act came in after the furor over 9/11. This law expanded anti-money laundering obligations for broker-dealers and banks and stuff like that. Key provisions include the requirement to implement AML compliance programs, which is the compliance officer, CIP, customer identification programs, where you have to identify the identity of your customer. You have to use a government ID, comparing to terrorist lists, OFAC and FinCEN, stuff like that. Now, there's often OFAC is for names of terrorists, drug traffickers, and other blocked persons. So you have every time a customer signs up, you have to run their name against OFAC before you sign them up. And if it does, you got to let the government know. There's also a FinCEN, Financial Crimes Enforcement Network. Every 2 weeks, a list of people who might be money laundering, stuff like that comes out. You have to run your customers against that list every 2 to 3 weeks. You have to run that names against the list. Now, nobody can see that list, but people who are allowed to in the compliance department. Okay, back to OFAC, a division of the U.S. Treasury that administers and enforces economic sanctions programs. Broker-dealers must not do business with individuals on the OFAC special designated national list, terrorists, narcotics traffickers, and must block assets or reject transactions as required. And you have to report shit within 10 days, but don't worry about that. Reg SP, I always think of super privacy, but it's privacy. It's part of the Gramm-Leachy Biley Act. Who the hell cares? It requires broker-dealers and investment advisors to provide initial and annual privacy notices to customers, explaining how their information, their personal information, is safeguarded and it's used. So like sometimes you have to send it out, but a customer can opt out of you sharing their information for certain things, for non-affiliated third parties. But here's the thing. The opt-out has to be easy. It can't be like to write me an email. Write me a mail. You can do email or a button or a click or a phone call. Any of that stuff works. It must be easy to opt out of sharing their information. Reg Show, SHO for short. Now, prior to 33 and all this shit, I mean, there used to be you could short sell without getting bars or locates. Now, according to Reg Show, again, they've done it, but they hammered it harder. All short sales have to, before you issue a short sale, you have to get a locate, find out where the shares are so you can borrow them if needed, or actually borrow them. So you must have a reasonable belief that you can borrow the shares. So that's what locating means. That look, if I want to short 1,000 shares of IBM, probably an easy to borrow list, and I don't have to do anything. But if it isn't, I can call up another broker dealer and say, hey, I don't need to borrow the shares, but do you have enough to lend them to me if I need to? And if they go yes, then we can sell the short. It also has closeout requirements that if you fail to deliver your short sales, the other side will buy you in, which means if I sell short and I don't deliver them to you, I couldn't get a borrow, whatever it is, you can issue a buy-in and buy the shares at the current market price, and then I have to take the hit if they're higher. So a buy-in is if I fail to deliver, you can force the shares to be bought by either me or you, and then you get the shares. This way you have them, because remember, you bought them from me, you're expected. Think about it like this. If I buy a car from you and you go, fuck it, I can't deliver it. This is the rule. So I need a car. So I'll go buy a car in the open market, pay whatever price, and you have to give me the difference of the extra. So if you sold me a car for 20 grand and then you never delivered it, I can go, this isn't a real thing, but it's an analogy. I could go buy the car for whatever I get, 25 grand, 30 grand, and now I have a car and you have to give me you have to pay the difference, that extra money, because it's on you. Also, Reg Show is what they call a short sell circuit breaker one. So like short selling, remember, short selling is bearish because you're selling stock you don't own. And sometimes that could push this price down. So if a stock drops by 10% or more from last night's close for the rest of today and all tomorrow, you can only short on a rising market. What does that mean? That means if it's bid at 42, you can short it at 42.01 or higher, but not 42. So you can't, so it prevents you from pushing the stock down. There's a whole bunch of new videos on that. I have videos on that, but just understand, Reg Show has to be able to deliver and you have to get a locate, but it also has this thing, the short sell circuit breaker, which means if the stock drops by 10% from last night's close, the rest of today and tomorrow, you can only short when the price is above where it's bid for or the last sale. Now we have Reg FD, fair disclosure. It's an SEC rule that aims to prevent selective disclosure of material non-public information by public companies. It requires that when an issuer discloses material, non-public information to certain persons, like analysts or institutional investors, it must simultaneously make the public disclosure to everyone. The point of this is to create a level playing field. Because look, what used to happen before the 90s, in the 90s, I'm a CEO, I would have a meeting with a bunch of the top analysts and all the institutional investors, and I would tell them stuff, and I wouldn't tell the public, so they would have a little bit of an advantage. So now, if I say something material non-public, I have to disclose it to everyone at the same time, so everyone has access to the information. That's fair disclosure. Sarbanes-Oxley, SOX, a corporate reform law passed in response to the accounting scandals and around WorldCom. That's where these companies are ripping people off, and the CEO goes, I didn't know what was happening. So now it established that it's going to regulate auditors and requires the CEO and the CFO to sign off on financial reports, basically saying, I know what's going on. So if they do something wrong, okay, so that's the thing. So Sarbanes-Oxley makes sure that companies, when they disclose, that the CEO and the CFO can't say, hey, I don't know what was on it. I can't tell. So this way they are on the hook if they lie. Also kind of strengthen the Chinese walls, which are like information barriers between like research and trading or research and investment banking. It strengthened that. Like they were kind of there, but they said, okay, you got to make sure that investment banking and research they don't talk to each other, not under the same pay structure, that the investment bankers can't pay the researchers, because there's a lot of fucking problem. So think about it. If I'm an investment banker trying to get investment banking business from Toys R Us, say, and the research puts it as a sell, well, it's going to be tough conversation. So prior to this, the investment bankers would control their research analysts and say, hey, you got to change that to a hold or a buy at least, because I can't walk into that office and say, hey, I want to do your banking business, but the broker dealer, my broker dealer has this as a sell. So that's fraud. So they made it so that the investment bankers can't control the bonuses, paychecks, or talk to a research analyst. They also can't be involved when underwriters are bringing out a new deal, like a pitch meeting or a roadshow. The analyst can't come on the trip. Frank came out after the crash, right? It's a sweeping financial reform law for securities, and among other things, created new categories like municipal advisors. You have to be registered, regulated OTC derivatives like swaps, and established a VOCA rule, which says set proprietary trading when people trade for themselves on the banks. It expanded the whistleblower provisions, and it gave, nobody ever pays this, but it gave, you can give tips for up to $1 million for whistleblower tips. I should find that. It also strengthened the regulators' ability to regulate banks. So all came out of the global financial crisis. FINRA Rule 2111, don't worry about the number. It's about suitability. The rule codifies brokers' obligation to make only suitable recommendations. So there's kind of three levels. There's reasonable basis, which means the product or strategy should be reasonable to someone, okay? Customer specific means it is suitable to your customer, and quantitative, that when you look at all the recommendations as a whole, it works. So my example is this. You're rich, you make a shitload of money. So I'm going to do munis. Okay, muni bonds could be suitable for some people. Now, you're rich, so munis would be suitable for you. But then when I look in your portfolio of 80% munis, I shouldn't add any more. So that would not meet the quantitative level. So it'd be excessive, so we shouldn't do that. So before we make a recommendation, we should consider the investment objectives, the risk tolerance, the time horizon, liquidity needs, financial status, tax status. New Reg BI started in 2020. Now, we used to just, brokers and agents used to just have to do the suitability standard. Now they have to do what's best for their client. Reg BI is best interest for their client, not just what's suitable. And that's where they have the customer relationship summary, this from CRS. It lists what the broker-dealer agent will do and can't do for the customer. So this is important. Retail customers, that rule 2011 applies to them all the time. Even if they say, I don't want it, doesn't matter. Institutions can actually waive it. They can say, listen, we can make our own, they can fill out a 2111 form, we call it, that's what we call it, and says, we are waiving your suitability requirements. Only institutions can do this because we can make our own decisions. We have our own analysts. So just throw shit against the wall, throw us anything you think will make money, and we'll make the decision on whether we should do it or not. They can waive that. Individuals cannot. Institutions can waive that. Or if they don't fill it out, then the agent or the broker has to do a suitability, figure out the suitability for the institution, and make recommendations only based on that. Here, 2210, don't really care about the number, is communications. Remember, broker-dealer communication to the public. If it's under 25 people, if you send something out with recommendations to 25 or less, it's correspondence. The principal will review it, not pre-approve it. If it's more than 25 people, the principal of the firm, written or electronic, has to be pre-approved by the principal of the firm. So correspondence is 25 or less, not pre-approved, just reviewed on like a random basis. If it's over 25, it must be pre-approved before they send it out. And if it's only go to institutions, don't worry about it. They just have to review it just like correspondence. You can't make, now remember something. You can't make false or misleading statements. You have to disclose risk. You have to make sure that you have a fair and balanced discussion about a stock. You cannot predict or project performance. Okay. The only thing you can do is like a target price, which is like their version of it. But remember, you cannot predict or project performance. Now, you also should, almost this is always a thing that's going to say, past performance does not guarantee future results. Almost everything that goes out should say that. Past performance does not guarantee future results. Then 3240, again, don't care about the number, borrowing and lending to customers. So it prohibits registered persons from borrowing money or lending money to any customer unless the conditions apply. So typically, borrowing and lending arrangements are only allowed if the customer is a family member, or it's a financial institution in the business of lending, or you have a prior business relationship with that person. Now, broker-dealers can lend to anyone under Regulation T, margin. But agents and IARs, let's go with agents for now, registered reps, can only lend to customers. Remember, if you're not a customer, who cares? But no can lend to borrow from customers If it's a family member, a lending institution, or you have a prior business relationship with the person, you can look that up. I'm going to do all the G rules, the MSRB G rules, but there's one that's important, the G37. This is for everyone. If you're a municipal financial professional, they have a thing called, they're trying to reduce pay to play. So certain political contributions are allowed and certain aren't. So as an MFP, this is a municipal financial professional that does not deal with retail clients, okay? You can give, as an MFP, up to $250 per election for someone you can vote for. So if you live in Jersey, you can give it to the local mayor, a congressman, someone. If you live in a town, those you can give $250 per election. Now, per election means they have a primary and a general. That's $250 each. If you give more than that, or you give any money to someone you can't vote for, you live in Jersey, you give money to the mayor of New York, Cuomo, whatever it is. If that's gonna, I'm predicting he's gonna win. So let's see if that happens. It's not March. We'll see what happens. If you give money to Cuomo, you can now you and your firm can no longer do negotiated underwriting deals with New York City or whoever you give too much for. So remember, if you can't vote, you can't give a dime. But if you can vote, you can give up to $250 per election. If you give more or give someone you can't vote for, you cannot do negotiated offerings with that entity, city, town, whatever, for 2 years, nor can your firm. Here's the fuck you part. If you leave your firm and go to a new firm during the 2 years, that new firm also has the prohibition for that timeline. Not another 2 years, but just the total of the 2 years from when you gave it. Here's a fine howdy do. It's called the 5130. I think I forgot what it was on the New York Stock Exchange. But this is a rule prohibiting, I call it the no IPO for you rule. It's a rule prohibiting broker-dealer personnel and other restricted persons like money managers, investment advisors from buying IPOs of common stock. IPO pretty much means the first issuance of common stock. Basically, it's there to protect the integrity of the IPO allocation process. Because look, if an agent, a registered rep, could get shares of an IPO, none of the good deals would get to the customers. So that's kind of the deal. You can buy in follow-ons. You can buy in the open market. You can buy in secondaries. You can buy preferred first-time issuances. You can buy bonds. It's common stock first-time issuances, which is an IPO. You cannot buy it. Now, once you're out of the business, you can do it. Now, there are exceptions, okay? Now, it's, by the way, it's called a restricted person. So it's anyone who works for a FINRA member firm and their employees, finders, fiduciaries, portfolio managers, and immediate family of those others. Now, everyone always asks this question. A lot of young people say, well, my students go, but I have a roommate. No, they're not. Unless you're paying their rent, they're not a problem. If you're paying their rent, they're not. Then they are subject to it. If you're not, then they don't. Now there are exceptions. If you work for, like, say you work for a broker dealer and your husband works for the issuer, and he gets directed shares, you can get shares because that's an exception. It's not often. If you're part of a hedge fund or a group and you're 10% or less of the ownership of that fund or investment pool, then the pool can buy it. If you're more than that, then they can't. But the hedge fund, the investment pool, can buy an IPO if they carve you out. They say, we're going to set up a separate bank account for just the IPO people, and the people that are registered reps can't buy any. That's where that goes. Okay, FINRA also has rules about senior investors that if they're over 18 and diminished capacity, or over 65 and just not normal capacity, you should do every effort to get a trusted contact person. And if you think they're being exploited, these are the rules. You can hold it. You can freeze the account, hold it to a temporary hold for up to 15 days, and then another 10 days if you need it. And you can actually go another 30 days, but you have to do some hoops. You can stop any kind of disbursements or trading. I think it's tough to say you can't pay their bills, but if you think they're being exploited, you can freeze and temporarily put a hold on disbursements and trading for 15 days, another 10 days. And then after you jump through some hoops, another 30 days for a total of 55 days. A lot of disclosures happens to get to the 30 part. But you're doing it to protect them. You're supposed to bring in their trusted contact person or investigate to find out what's going on and tell your supervisor. Now let's talk about when shit goes wrong. Okay. Insider trading, it's the illegal act of trading a security, buying or selling, while in possession of material non-public information about the issuer or the security in breach of a duty of trust or confidence. Insider trading violations can involve corporate insiders, officers, directors, employees, or others, tippers and tippies. So the tipper tells you, the tippy gets the information, who misappropriate confidential information. The penalties for insider trading are severe. Individuals up to $5 million in fines and 20 years in prison. and the SEC can seek civil penalties up to treble 3 times the profit gained or loss avoided. In practice, firms implement insider trading policies, Chinese walls, information barriers, restricted list, watch lists, require a supervised person to pre-clear or report trades in certain securities to detect and prevent insider trading. So the insider trading, remember, having the information isn't the problem. Acting on it is. So the rule is kind of if you get inside information, either shut up or tell your supervisor or compliance department so they can tell you what to do with it. I'll tell you where you can put it. Okay. Tipping, the act of divulging material, non-public information about a company to someone who then trades on it. Both the person who tips and the tipper and the tippee can be liable. So this tipping culture is horrible. Maybe that's what they mean. If the tipper breached a fiduciary duty in disclosing the info and derived the benefit, even if its reputational friendship benefit from tipping. For instance, if an insider tells a friend good news is coming buy a stock, and the friend trades, both can be charged. Just know not to share non-public information, and if you get the information, tell it to compliance, and remember something: you can't act on it, you can't tell them anything. So, if you find out that a company is going to declare bankruptcy tomorrow, and little granny walks in your office and wants to buy stock, you cannot say, hey, listen, hold off on a date. If you can find another reason not to buy it, fine. But if she wants to dump her entire savings into it, you kind of got to let her. Okay, front running. The unethical and prohibited practice of a broker trading a security ahead of a customer's large order or ahead of a firm's own block order in order to profit from expected price movements. Now, in real world, trading ahead and front running are very similar. On the vendors, they love to say trading ahead of a research report, which is jumping in front. When you hear, like, say your buddy tells you that there's a research report coming out that it's good or bad, and you act on it before it's public. That's bad. It's not insider trading, but it's trading ahead of a research report. It is prohibited. But front running is jumping in front of a customer order. Now, firms must have policies to detect it. Churning, excessive trading in a customer's account by a broker to generate commissions without regard to the client's investment objectives. So again, churning is a violation of suitability rules, ethical conduct, manipulation, everything, okay? So churning is when you do extra trades. Now, understand it's relative. So like if you trade once a month for twice a month for my mom, that could be churning, but trading 10 times a day for Mark Cuban might not be churning. So you look at everything, the character of the account, what their objectives are, who they are, stuff like that. But you don't look at gain or loss. Gain or loss has nothing to do with it. So whether you make money or lose money, churning is churning. Now, the other thing is there's a thing called reverse churning. Reverse churning is if you have a wrap fee and you're getting paid regardless of the trade you do, and you literally ignore the account. So churning is excessive trading. Reverse churning is when you're getting paid regardless of whether you take care of the account or not, and you basically ignore it because you're just getting paid. Now, marking the open and marking the close. That's a form of manipulation where traders execute purchases or sales of a security near the close of trading or the open, specifically to influence the stock's opening or closing price. For instance, a person might place a bunch of buy orders right before 4 p.m. to bump the price up, or sells, or whatever it is. So marking the open, marking the close is placing a bunch of trades, and maybe not even trading them, just orders sometimes to get the algorithm to kick in, called spoofing sometimes, to make the price of the stock close or open at a certain price. Because remember, if I'm a trader and I want my profit and loss to not look bad, I may try to push the price up. Or if I'm selling puts, I may push it up so I don't get exercised. Painting the tape, manipulating a manipulative scheme where a group of market participants or a single person can do this, trade a security among themselves or himself, self-love, to create an illusion of high trading volume or interest, thereby attracting other ventures. So it's a wash trade, matched orders. They're painting the tape, okay? So either I can do it myself, like say I have an account at JP Morgan and I have an account at Goldman. No firms have been harmed in the filming of this. So JP Morgan and Goldman, I buy back and forth the same stock from myself. I put a buy order out, I sell it to me. I put a sell order out, I buy it for myself. That's a wash trade, that's painting the tape. Or we do it as a group. And again, a matched order is pretty much the same thing. We're basically a prearranged plan where two parties agree to buy and sell each other's orders at the same time. This is a form of collusion, okay? Now, the whole point of painting the tape wash trades is when a trade happens without any change of beneficial owner. So Mike Goldman buying from my JP Morgan account is considered a wash trade, painting the tape, matched order. It is illegal. Free riding. Okay, there's two. There's free riding, which is when you buy and sell trades, when you buy and sell a stock. Remember, you have 3 days to settle and pay for this. So if you buy a stock and then sell it for a profit and never pay for it, and get, just use it, and you never pay for it, that's free riding, and then they withhold your account. That's free riding. Free riding is in an account when you buy and sell trades, hopefully for a profit, and you don't pay for it. So they freeze your account for 90 days. It really doesn't mean a lot. It just means you can do anything: margin, withdraw money, pay bills, trade. They just won't accept your order unless the money's in the account ahead of time, and it's for 90 days. I talked about it earlier. Now, free riding and withholding. It's basically a prohibition on the underwriters from withholding shares. So if I'm an underwriter and I'm going to sell shares to the public or a broker dealer, anything, and I go, you know what? It's a really good deal. I have $1 million to sell. I'm only going to sell 800,000. I'm going to hold back 200,000 myself, and then I flip it out for a profit. So that's illegal. You can't do that. So free riding is when you don't pay for a trade. Free riding and withholding is an IPO when the underwriter holds back some of the trades. Backing away. Back away. Okay. A violation in which a market maker fails to honor a firm quote. Remember, all quotes are firm. So if I make a $10 bid, offer at $10.50, it's firm for 100 shares or whatever I put. Now remember, the minimum trading unit for the 90% of the shit is 100 shares. So if you see I'm bidding 10 and offering 10.50 and there's no numbers, it's assumed that it's 100 shares. But I can do more than that. I can say 4,000 or 5,000. But if I make a bid, whether it's for 100 shares or 1,000 shares, right? If I make the bid or the offer and you come in to sell or buy it from me, I can't go, I was just kidding. So the point is, I make a bid 10 for 1,000 shares. You want to sell it to me. I go, I don't want to do it. That's backing away. If I make the bid and you hit my bid, I have to honor it. Now, there are exceptions. If another trade has already happened where I've already bought the shares from someone else and I'm in the midst of changing it, or I'm just in the midst of changing the order and you caught me while I was changing it, I can get out of it that way. That's why there's a CAT system, CAT, which tracks when the orders come in and what you do. So they can say, he was starting to pull it out when the order came in, so it's not backing away. But it is a breach of NASDAQ FINRA rules. So again, it's when a market maker makes a bid or offer, a firm quote or offer, bid or offer, and they don't honor it when the other side comes in. Selling away. Okay. Some of you guys have accounts away from your broker dealer, or you do trades. We'll talk about that. This is the act of RR engaging in private securities transaction, sales of securities outside their employment outside the member firm, with or without permission, right? So with permission is a private securities transaction. Without permission is selling away. So there's two ways this happens. One, if you have a brokerage account and you do personal trades without getting permission, and you don't get approval to open the account or do the trades, that's selling away. If you get permission, it's private securities transaction. However, the other one is if you're a rep and your buddy comes up to you and says, I have a new golf, I have a new tutoring app, and I want you to help sell it and raise money for me, and I'll pay you a commission. You need to get permission from your firm ahead of time. If you do, and they'll always say no, but it's a private securities transaction. If you don't get permission, it's selling away. Pay to play. I think we talked about this. An arrangement where business is awarded in exchange for political contributions or other favors. In the securities context, the focus is usually on municipal finance professionals and how they can only give $250 per election. Okay. So this is the one. So basically, it's a bribery through donations. I give you a donation of more than the $250, and I expect you to give me back some business or send investment banking or whatever is my way. Or have your pension, like a lot of times if it's state, it's to direct the pension managers to send me orders. If you should know this for the Series 7 and the 53 and the 24 and all this. If you give more than $250 per election for someone you can vote for, then you're a violation. If you give anything to someone you can't vote for, that's a violation. And what they do is they go, okay, to avoid this, if you give more than $250 or even a penny to someone that you cannot vote for, you are not allowed to do negotiated offerings with that city or state or whatever municipality for 2 years, or is your firm. Okay, your firm can't do it either. And if you move to a new firm, That new firm is tainted by your evilness also for the entire that 2-year period. It's not a new 2 years period. It's from when you do the donation, it's 2 years. So if you switch firms, all three, if you go to another firm, all three are subject to that 2-year ban. They did that so people wouldn't bury their old firm and go to a new one and then go, oh, I can do business. Conversion or misappropriation. In a brokerage context, this refers to a broker or employee stealing or converting customer assets to personal use. It's fraud and criminal, okay? If you ever look, FINRA does a quarterly newsletter where they basically publish what people do wrong. This happens all the time, where they have an old person who's either dying or they're dead or they're diminished capacity and they don't have anyone watching the account. They go, hey, they won't notice a quick 50 grand in my account. They get caught all the time. So conversion or misappropriation is taking customer accounts and moving it into your own. Even if you're trying to pretend that doing it for them, you're not. Broker dealers are you're barred if you do that shit, unless you have a really good lawyer. Most broker dealers have the FINRA has segregation rules. They require customer assets to be kept separate from firm assets to prevent this kind of misuse. Like an example of this is if I send a check in to my branch manager and he goes, ooh, he whites it out, puts his name in, and then takes the money in his own account, stole it. Guaranteeing against a loss. It is prohibited for a registered rep to guarantee a customer against losses in their account or any transaction. The only way you can sort of do it, not really, it's against law. But like if you even then you lose, right? So if you buy stock and then the only way it could happen is if you buy stock and then the stock rises and then you buy a put where the premium is less than the rise, then you're not going to lose money, but it's okay, right? So that's guaranteeing a floor. But again, when the put's gone, the protection is gone. Now, you can guarantee a price. So a lot of times, first of all, you can't reimburse someone for losses. But if a big order comes in, you can guarantee a price that they're going to buy it at, not the loss. So a lot of times when we had institutional clients, they call up and say, I got 1 million shares to buy. And we'll guarantee you on the first 200,000 that you could buy it at the VWAP, which is the average, or like the last sale. We're just saying we'll do that. We're not guaranteeing it's a loss. We're guaranteeing them a price. It's kind of like stopping stuff. Okay. Sharing in customer accounts. FINRA rules prohibit brokers from sharing in profits or losses in a client's account unless the employee has the firm's written approval and if the sharing is in direct proportion to the capital contributed. Now, if it's family, it's not as big a deal. You can do that stuff. However, you cannot take a percentage of the gains and not have the losses. So if I want to do an account with you, I put in 20 grand, you put in 20 grand, we're 50%. Okay. If I have 40,000 and you put in 60, then I'm 40%, you're 60%. That's really what it is. It's almost always prohibited and it's very hard to get an approval, but you can do it. IARs, investment advisor reps, can never do this, but they can if they have a certain customer called a qualified customer. They can do what they call a performance-based fee, where they get a fee based on how well the performance is. Okay. Complaints. See, bad shit, right? Oh, if you do any of this, you get a complaint. A complaint is any written statement of a customer or any person acting on behalf of a customer alleging a grievance involving the activities, securities, investments. Okay. The firms have to have procedures to document and respond to complaints. So if I get a written complaint, I have to immediately follow the procedures, but literally send it to my supervisor or principal and have to handle it. FINRA doesn't tell you how to handle it. They just say you have to and keep records of it. Okay. Now, for the most part, most firms won't let reps get mail directly. It has to go through compliance and open, and then they can get it. I don't know if that's changed or not, but that's kind of how they prevent this. But if a customer calls up and yells at you, it's not a complaint. No, FINRA says you should tell them to send it in writing, but why the hell would you do that? Okay. Again, written complaints, text messages, emails, shit like that, and they have to be kept on file for 4 years. Okay. You have to avoid saying anything demonstrative, like you have to avoid appearing to guarantee results. You must avoid a language that implies guaranteed outcome. Even something saying like this stock is a sure thing or you can't lose, that's a problem, okay? And any kind of communications must be fair, balanced, and not misleading. So superlative and promissory statements are not allowed. You have to give the good and the bad. You have to be fair and balanced. Okay, parking is not that parking in a car. So parking is doing just two different things. Parking a license, which I know you guys will never do. We know that if you leave the firm, you have 2 years to reassociate. And actually with MQP, you have another 3 years on top of that. But you have, say, 5 years total to get your before you lose your license. So a lot of people are tempted to park their license, find a firm, they'll pay them, and the firm just registers them without doing stuff. You can't do that shit. Now, parking in the form of bad shit is also parking your securities. Parking a security is temporarily holding securities in another person's account to conceal true ownership or to evade net capital or position limits. So this is what happened in the 80s and 90s. It was a lot of Boski and Milk and stuff. They were buying companies. And, once you hit 10%, you have to do a 13D or G. So they get to like 9.9%. And then they call their friend and say, listen, go buy, up to 8% of the company, and I'll guarantee you against losses, right? Okay. So then now technically I control almost 20% of the company and no one knows. So I may reach out to like 10 different people and say, buy 5%, and tell all of them to buy the 5%. I'll guarantee against a loss. So then when I do a takeover, then I know that all of them are going to say yes. So I basically can control the company in seconds, right? Not seconds, but weeks. And then when I file the 13D, like I literally own 40% of the company when I'm supposed to do it when I control over 10%. So parking a security is when you get other people to hold securities to hide the ownership. It is a fraud. Breakpoints are great. That's volume discounts. Breakpoint sales are bad. It's an unethical practice of selling mutual fund shares just below breakpoint where sales charge or drops. So remember, a breakpoint on a mutual fund is when you put a certain amount of money in, the sales charge goes down because you put more money in, right? So if you put someone in just below breakpoint and don't tell them that if they put more money in, they get a breakpoint, that's a breakpoint sale. So there's two ways to do it. One, they put it in and you don't tell them. The other one is a little sneaky. Say the breakpoints are 50 grand each, and somebody has like 200 grand to put in. You put like 48,000 in T Rowe, 48,000 in Fidelity, 48,000 in Vanguard, and then 48,000 in Tiger or something like that, right? So you're in four different things just under the breakpoint. They don't have the same, but let's say they do. So instead of them getting like a 3% sales charge because they put in 200 grand, you put it in four different funds, right? Fund families, which is what I was talking about. Even if it's like large cap Vanguard, mid cap Fidelity, small cap this, because every fund family offers so many choices, there's no reason to do that. That is literally breakpoint selling by putting them in different fund families. You're not going to get it. Now, they miss out on the discount. Now, that's a breakpoint sale. So FINRA requires that reps disclose breakpoints and discounts and make efforts to get the investor the benefit of eligible breakpoints. So basically, you're supposed to do everything you can to get it. Shadowing, a term used when a broker executes a personal trade immediately after executing a substantial client trade. It's like piggybacking on the impact of the client's trade. If it's done knowingly to exploit a client's trade, it's akin to front running or at least unethical. Now, here's the thing. So I should have said this before. If front running and shadowing are bad, like buying before the customer or buying after is bad. Now, technically, if I have one trading desk that has a big buy order and I'm in another trading desk and I don't know about it and I buy the stock before or after, that's not front running. So they have what they call information barriers or aggregation units where like their retail desk and the market making desk and the risk arb, I use that word again, or like the any kind of the underwriting desk. If they get an order in their desk, as long as there's a separation of knowledge, then the other desks can trade all they want without worrying about what the retail gets. So it avoids the whole shadowing and front running. Okay. Commingling, sounds a little sexy. Okay, like canoodling. The commingling is mixing customer-owned securities or funds with those of the broker-dealers. You can't do it. By law, broker-dealers must segregate customer funds and fully paid securities from firm assets. Okay, this isn't a bad thing, but it's a thing. Fiduciary duty. While brokers traditionally operate under the suitability standard, well, Reg BI is going to change that. Certain accounts like discretionary accounts or acting as an investment advisor or custodian accounts impose a fiduciary duty, the highest standard of care. Okay. Meaning the rep must act in the best interest of the client with loyalty and care. So it's the prudent man rule. Now, if I have a fiduciary responsibility, I have to do what's best for the client, even if it's bad for me. Under suitability rules, I have to pick something that's suitable. I don't have to do the best thing. Under fiduciary reg BI, you have to do what's best for the client, not what's just suitable. Foreign Corrupt Practices Act, FCPA. This U.S. law prohibits bribery of foreign government officials to obtain or retain business. For broker-dealers and banks, that means they cannot make improper payments to foreign officials. God damn, it fucking makes sense, right? You try to send stuff to foreign officials to secure underwriting deals or asset management contracts with their sovereign fund. We talked about sovereign fund. Sovereign funds, I think we did. Sovereign funds are when a foreign government we're trying to do one here, like Trump's trying to do one now. With a deficit, it's hard. But when countries have surpluses, they invest the money and they use it, okay? So this requires publicly traded companies to keep accurate books and internal controls to prevent this kind of slush funds for bribes, okay? Bribing is not good. So FCPA is about bribing. Okay, now let's go into the other stuff. A wash sale, okay? It's not a violation. So wash trade, I talked about violation. A wash sale is when you sell stock for a loss and then you buy back into it within 30 days, you lose the tax deduction. Now, you can use it later, but so a wash sale, you disallow a tax loss. Remember something, because if you lose money trading, you can use that to offset any capital gains and up to $3,000 of your ordinary income each year, and then you carry forward to the next year. But if you do a wash sale, you want to say wash trade, but wash sale, you cannot do that because you sell stock for a loss. Then 2 weeks later, you buy the stock back for some reason. I've done it, made mistakes that time. You no longer can take that loss until you actually sell the stock. So they adjust the cost basis up based on your loss. And then when you actually sell the stock and see out of it, then you can take the loss. So it's almost like you avoid the loss this year, but you can take it next year if you sell the stock. Okay, this is more investment banking stuff. Okay, here we go. IPO, it's just going to be one-liners. IPO, first sale of a stock to the public, usually common stock, first time. A follow-on or an additional is when they issue the second, third, fourth time, okay? So they're both primary offerings. So IPO is the first sale of securities to the public, okay? Common stock usually. A follow-on or an additional offering is when they do it a second, third, fourth time when they try to raise money. Best efforts, remember, underwriter helps an issuer raise money. So they have different types of underwriting. A best efforts, the underwriter tries to sell as many shares as possible without guaranteeing anything, and anything unsold will be returned to the issuer. Now they have under best efforts, they have an all or none, which means you're going to sell all of the shares or cancel the deal. So if I give you 1 million shares to sell and you sell 900,000 and it's an all or none, cancel the deal. But I can do a mini max, right? So a mini max is I want to sell 1 million, but if you get to a minimum of 600,000, then we're a go. So all or none, so all of it or none of it. Mini max is sell as much as you can. If you can get over the minimum, then we're a go. But if you don't get the minimum, we're out. Now, both of those are what they're called contingent offerings because it may not go. So all the money has to be in an escrow account. They don't want the broker dealers touching that money until to go. Okay, that's best efforts. We do the best we can. Firm commitment. The underwriter basically guarantees it by buying the issue and then selling it to the public with markup. So again, usually best efforts is considered an agent transaction, but a firm commitment is where the underwriter will literally buy the shares, pretty much, buy the shares at like 19 and sell them to the public at 21. And that's firm commitment. We're guaranteeing sale. The issuer has no risk here. Best efforts, the issuer has risk. A firm commitment, the issuer does not have risk. A shelf registration. This allows WICSs, well-known seasoned issuers, big firms that have like 700 million in float or $1 billion in debt, and they've been around for a while, no crime, they're big-time companies. They're allowed to file an S3. And what happens, instead of selling it over a year, they can sell it over 3 years. They can do it all in 3 years or do it a little bit every day if they want, called an at-the-market offering. So these are kind of things that that a WICSI, a well-known seasoned issuer, can do. That's called the shelf, because it's like getting permission, filing an S3, getting effectiveness from the SEC right away, and then you almost put it on a shelf and then sell it when you want to, and it's good. Okay. You might do that when the markets are volatile and you want to wait for it to go up, or you do it when you want to sell a little bit out at a time. You can do that. You can sell out, like, say you get a permission to sell, 100 million shares. You can do like 20 million a month if you want. Okay. A public offering is when securities are sold to the general public. That's an IPO, follow-on, shelf. A private placement, it's where they sell securities directly to accredited investors. That's a Reg D for the most part. Pipe, let's get on the pipe. Private investment in a public entity. That's where a publicly traded company like Home Depot will sell a block of shares to a bunch of accredited investors in a private placement. So it's like a public company, like a Home Depot, Microsoft, shit like that, and they sell shares in a private offering to accredited investors. Now, when we're doing underwriter, we can have what they call a market out clause. A market out clause it allows the underwriter to withdraw due to adverse market conditions. So we'll use an example. Like, say March 5th, I get an underwriting of 2020, I get an underwriting deal, and then I'm going to go out in the middle of March, and boom, COVID hits. They go 2 weeks for the cure, and what happens? We shut down. That's a market out. They go, look, there's no way I'm going to sell my shares during this crazy time. So I went out. And this way you can get out of the deal without paying a penalty. Okay. The underwriting spread. That's the difference between where the underwriter buys the shares from the issuer and sells them to the investors. So that's what I said before. So if I do a firm commitment, the underwriter will buy the shares at 19 and sell them at 21 to the public. That $2 is the spread. There's all little parts of it, but we don't care. There's video. A qualified independent underwriter, a QIU, is an independent underwriter. Basically, if like say a broker dealer wants to they want to issue their own shares. They want to be their own underwriter to sell their own shares. Well, there's a conflict of interest. So they'll bring in a QIU, qualified independent underwriter. There's a lot of rules for this to make sure there's a fair and balanced pricing to avoid conflicts. Now, this is a great one. A green shoe clause, not a green shoe, it's a green shoe clause. If I'm an underwriter, okay? If I'm an underwriter, it allows me to issue more shares. So if I issue, I'm backing up. So let's say I'm an issuer, I give you 1 million shares to offer. And it's such a great deal because my company is just fucking awesome, right? So many people want it. It allows you, the underwriter, to sell an extra 15%. There's other parts to it too, but the whole point of it here is that you're allowed to sell another 15% out of the shares, okay? So if I do 1 million, you're allowed to do another 150,000. And what that does is, since I haven't printed them yet, you're technically shorting them. So you'll buy them in the open market and maybe get them cheaper or whatever it is, okay? So again, a green shoe clause allows the underwriter to sell an additional amount of shares, pretty much 15%, without having to come back to us. Now, after it's issued and it's IPO and it's trading, the lead underwriter or a underwriter, the brochure 9 times out of 10 to leader, will do a stabilizing. What that does is stabilization is where they buy the shares. Like say the IPO is at 20, they'll buy the shares at 20 and keep doing it to keep it from dropping. Because remember, people sell, prices go down, people buy, prices go up. So they'll buy stock at 20 to hold it there from dropping until the news gets out. They won't do it forever. They'll do it for a little while. That is manipulation. So it's legal manipulation. It's weird. It's allowed. There's rules. They can't buy above the IPO price. They can't push it up. Like if the stock's trade, say the IPO is at 20 and the last sell is 19. They can bid 19. They can't bid higher than that until it trades up on its own. So if somebody bids 1905, then they can bid that. If it trades at 1920, they can bid that. They cannot bid for it higher than it's trading or the less or that where a higher bid is. Okay. Now other things. Beta, that measures stock volatility relative to the market. So if the stock has a beta or portfolio has a beta of 1.5, it'll move 1.5 times the market. I call it a multiplier, okay? So let's say say you have a beta of 1.5 and the market goes up 10%. You're going to go up 10 times 1.5, which is 15%. And if the market goes down 10%, you go down 10 times 1.5, which is 15%. So a beta of over 1 means you're very volatile. A beta of under 1 or down to 0 means you're very conservative. You're going to move less than the market. If you have a negative beta, it means you move opposite of the market. So it's a multiplier. Now, alpha dog, right? Okay, so now alpha is what you do better than expected. So let's do that. It measures a stock's exit return over expected performance. So beta does expected, and alpha is what you do above that. So let's get into that. Let's say you have a market return. The market's going up 10%. You have a beta of 1.5. You're going to do 1.5 times 10. So 15% is your expected return. If you, the portfolio manager or the stock does actually 18%, well, we expect to do 15, we did 18, that's positive alpha of 3. If we do 14%, that's a negative alpha of 1. So alpha is what we do better than expected. So alpha and beta kind of go together, kind of like Revenge of the Nerds. Okay. Sharpe ratio. It's a risk-adjusted return. It's basically it's your risk premium. Doesn't matter so much, but it's a risk premium divided by standard deviation, which is volatility. So let's talk about that. Sharpe ratio, SHARPE ratio is a risk-adjusted return. So it's gonna come up with what, adjusting for risk, what your expected return is. That's all it is. Okay. Efficient market hypothesis. It's a theory that stock prices are efficient, like the market is efficient. What efficient market means is that the price is right. So like efficiency means that there's no discount, no premium. You're not going to get a bargain. So efficient market theory believes that the market is efficient and the price reflects what it should. So there's 3 theories: weak, semi-strong, and strong. Weak form, okay? Weak form believes that historical prices, like technical trading doesn't work. Just because the stock traded up 10% every year for 20 years doesn't mean it'll keep doing it. But they do believe that fundamental, you can maybe find a diamond in the rough or maybe find an undervalued stock using fundamental analysis. It's the only one that believes that. Semi-strong believes that all the news that is public is reflected in the price. And any new news, GNU, if you ever, Great Space Coaster, Gary GNU, if any new, it's a fucking ADD rant. Any new news, all the news and news, anyway. So any new news that comes out, the stock will quickly move to the price to reflect that news. That's semi-strong. Strong believes that inside public knowledge and inside information is built into the price, basically believing that the market reflects both people, trade, and inside information. So they believe you can glean nothing from knowing inside information because it's already built into the price. I think there's a mix of someone there. So weak believes in fundamental. Semi-strong believes in all news that is public is built into the price. And strong believes that all news, both public and private, is built into the price and it reflects that. Okay. Modern portfolio theory believes they emphasize diversification to create an optimal portfolio. So we're trying to increase our portfolio return by diversifying without increasing the risk. We're looking for the efficient frontier, for the optimal portfolio, the highest return for a given level of risk. So if we have a given level of risk, we're trying to keep increasing the returns without increasing our risk. CAPM, capital asset pricing model. It estimates expected returns based on risk. So basically, it says the more risk you take, the better return we get. The less risk you take, the less return we get. So basically, they're going to look at a level of risk, which is standard deviation, and say, if you do this, you should earn 17. If you do this, you should earn 15, or some with some variance. Okay, so CAPM predicts returns based on the level of risk. Correlation coefficient. It's basically how two securities move with each other. So if you have two stocks that are a correlation of 1, that means they move together. If you have a correlation of 0, they have nothing to do with each other. If you have a correlation of -1, they move exactly opposite. If you have a correlation of 0.5, one goes up 10%, the other goes up 5%. So correlation is how much two securities move with each other. To be diversified, you want to be very close to 0. Okay. Monte Carlo, go to the bank or go to the casino. Monte Carlo is where they run potential problems and portfolio outcomes. So again, Monte Carlo theory is basically running scenarios at a portfolio to determine what the hell they will react, or a stock or whatever it is. So Monte Carlo simulation is running scenarios at a portfolio or stock to determine its risk or how it's going to react. Stay tuned for part 3. It is coming at you super soon as I record.